Okay, and we're live. Good morning, everyone, and welcome to another episode of the Crypto Hour. Today, unfortunately, as in the past few weeks, say in the past few months, really, the talk has been dominated by the macro environment. Okay, and you would be aware of it, especially if you follow the news in any type of news, the US, UK, wherever you are in the world. Probably they've been dominated at the moment by the debt ceiling discussions in the US. Kind of like in a way, the US, government is running out of money because the debt ceiling is determined by Congress, and the Congress is in the hands of Republicans. President is a Democrat, so there is a little bit of to and froing between them to agree. So one or two options. Basically, keep the debt limit at what it is, and that will mean a default of the United States on its on its debts, on its bonds, etc., will the consequences that brings, or what's happened already over 70 times in history since we've gone to fiat to a fiat currency, is increase the debt ceiling. And so give the government basically more money to spend. So, what does that mean? Printing more dollars, etc., etc. So let's have a look at what, how we can make any sense of this. Okay. So I'll start sharing. Wait a minute. Let me just. Okay. Close this. Sorry, Jaya, I've made you, if you don't mind, I've made you co-host so you can
sure, no worries.
Let people in, if you don't mind, as they come in. Okay, first of all, let's start with a question. Okay, this is the shortened version of this week's economic announcements. Okay, so just the red ones, so the important ones highlighted. Can you just, so I'll just give you a brief brief commentator of the what was announced. First of all, just look on the left column, which are the actual results. The other ones are the previous and the forecast. Okay, so as you can see, the red dominates. Okay, which is just the first glance. Okay, so the Empire State Manufacturing Index, which is a surveys of manufacturing managers. Again, it's negative and quite a lot more than expected. So it's implies a deteriorating condition for the manufacturing sector. The UK shows it starts showing an increase of the jobless rate, basically, so the people that claim benefits. From Canada, we had the inflation rate keeps going down. Obviously, it's red from the point of view of currency, because a low inflation rate means that lower, a less necessity to increase interest rates. Okay, so that goes down. In the US, we had core retail sales going positive, but you can see it's red because it was below expectation. Okay, and then we had again deteriorating work conditions in Australia, where the actual employment rate went up by 0.2%, and so on. So when you look at all of these, can you guess which one is the most important of the announcements, and the one that's likely to move the markets, that has moved the market, is likely to move the markets out of all this list?
The talk today of the Chairman.
You got it in one, Eric. Well done. So, and this is because nobody has a clue really about what is going on and where the economy is going to go next. Not because we can't guess, because the numbers are kind of like clear enough. But honestly, where the economy will go next depends on the decisions that will be made. Especially from the Fed and also from the political sector in the US, which is the largest economy in the world. So a lot of weight is put onto kind of understanding what the frame of mind of the Fed is, and obviously the one time when we can guess what their idea is analyzing when they give a speech for any reason. Okay, so today at 4 p.m. in the UK, so that will be what 11 a.m. in the US. There will be this talk which can see quite a lot of spikes in volatilities in any market. Okay, I'm not talking about stock markets, but generally speaking, to any market. Now let's go and have a look at also just to show you a correlation. You know, why we look at these things and why these things are important. So this is today. Today, apart from the consumer confidence in the UK, which affect the UK, but the other big announcement was the inflation announcement. And as we've seen, inflation figures are dominating at the moment and moving the market. So in Japan was announced an inflation rate that is higher than what people expected, at now at 4.1%. And so, sorry, 3.5% and 4.1%, which exclude food and energy. Okay, now just remember that Japan is the only nation that hasn't really increased interest rates as the rest of the world. That has kept a very, very low low interest policy, and kind of like this is seeing the inflation rate go the different direction from most other economies. It kind of like it increases the pressure on the central bank to actually increase interest rates. So if we go and look at it in the charts, what does that mean? What would the market expect? The market would expect them to, sorry, let me just go on to the yen. So these are the yen futures. Okay, as you can see, you know, after the announcements tonight, there's a spike and the yen started going up. Okay, why? It's because obviously if people expect the interest rates to go up as a result of, you know, they needing to control the interest rates, there is kind of like a, you know, it changes the balance between the yen and other currencies. Okay, so this is basically an inverse of the US dollar yen chart in foreign exchange. Okay, but this is basically the yen futures are the yen dollar. All the futures are the pairings of that currency against the dollar. Okay, so if you're looking at the euro, the pound, the New Zealand dollar, whatever you're looking at, their futures is the kind of like the rate of exchange between that currency and the dollar. Okay, so this is why we look at interest rates, and because inflation, because inflation determines interest rate policy, and interest policy differential determines the exchange rate between different countries' currencies. Okay, now moving on to other things, I will show you where we are in terms of just to get a general idea what happened in the markets this week. So let's go back to where we were. Sorry, let's go on to maybe a 4-hour chart. So move this always in the way. So this was where we were last week. Okay, around this time. This is the S&P 500, and there have been quite a climb in the market. So we've been, as you can see, in a range really for all of 2023, and this week we actually made new highs for 2023. Okay, we've actually, so this is February, so we're going above February's high. So we haven't quite gone as high as the 2022, you know, the August peak of 2022, but we are making new highs for the year. And in particular, the one that is even stronger than this is the Nasdaq. You know, the Nasdaq being the technology, technology index really. And when you look at, you got to be a little bit careful here, because in both the Nasdaq and the S&P, you know, they have been, you know, really, really dominated by a small number of stocks, and that especially being the kind of like Apple, Google, Amazon, the top 4 or 5 stocks actually represents in weight the biggest part of these indexes. So it doesn't really mean that it's, you know, everything is rosy and the whole economy, the US economy is doing well, but it just shows you that these particularly the strongest components of these indexes have performed particularly well. And you can see the difference with the Nasdaq is actually they have gone above the August 2000, not just they posting new highs for the year, but they've gone above the 2022 highs as well. Obviously, there is a long way to go before we get to kind of 2021 highs. Okay, we're talking about an extra, at least 20% from where we are now, but still, it is making some interesting progress. Now, this is what the market is doing, and the market generally reacts on a kind of short-term basis. But let's have a look at what is really happening in the economy. Okay, let me just show you. So this is the debt ceiling. Okay, which at the moment stands at $31.4 trillion. Okay, as you can see how it has increased from when there was no debt in the 1940s and 60s to progressively, so in 1971, when we moved from a gold standard to the current fiat system, as it's progressively increased and get higher and higher. And at the moment, if you were just looking at a chart from the point of view of investors, what you would want to bet on is you would want to bet on this getting higher, not getting lower. But just to give you an idea, so we are at $31.4 really trillion, okay, and growing every month. Now, just to give you an idea, in March, which are the last figures that we have, the US in revenue got in $313 billion. Okay, so this is tax revenue for individual, social security contributions and so on. Now, do you have any idea about how much in the same period, in the same month, the US spent in? So this is what, it's just talking about it on a personal level. You have money that you earn every month, and then you got your expenses. Now, this is what the government has earned. Have you got any ideas about what the expenses were in the same period, in the same month? Anybody would like to have a guess?
That'll be 6% of that, right there, or 5%.
Sorry, 5% of that, or what? Sorry.
Got to be 5% of the 31 trillion.
Okay, in a single month.
Right, divided by 12.
Okay, that's yeah. So that would be a little bit, more than normal. That would be like in the kind of Argentina mode, really, Venezuela mode. It would be, but it's the just in debt servicing alone. So what they spend in interest pay on this, and remember they got 313 billions of revenue, is 67 billion in interest alone. Okay, so we are about over 21% of whatever comes in being spent just to service the debt. Okay, and the total, when you include like Medicare and Social Security and all the things that you really would be very, very difficult to cut, okay, the total comes to 691 billion. Okay, so the US is spending at a rate of more than double what it gets in. Okay, so this is kind of staggering. And if it was a normal person, a normal company, it would have been declared bankrupt a long time ago. Okay, now obviously a country cannot go bankrupt because they can just technically they can they issue their own currency, so they can just carry on printing more. Okay, so let's have a look at really what determines, apart from this debt discussion. Okay, and we can talk about what this means, because there are really, really big implications if the US was not to renew, to increase the debt ceiling, because that would mean defaulting on the bond. So the first thing that would happen, so this is kind of like guaranteed, there's no doubt about this, would be that the rates they would have to pay on any new debt that they issued will go up significantly. So at the moment, the long-term rates are, let's go back to let me just show you what the long-term rates are. And the zoom controls are always in the way. Okay, so the 10-year rates are 3.6%. Okay, so we're looking at the long-term rates. Okay, So the 3.6% on a 10-year basis. So let's go back to the other screen. So from 3%, you would again move to an extra at least above 5%, or because people will not trust the borrower, which is the US government, as a trustworthy entity, because they have defaulted on commitments that they had before. So if they don't pay the interest on their debt, especially if you already hold some of those bonds, and those coupons don't keep coming, would you really put more money in it and give them more money, knowing that they already let you down? Okay, so even people that would be happy to put more funds in, they will require a higher reward than they're getting now, because there is more doubt now about the borrower. So that, that will be starting a domino effect, a cascade of things. What would that cascade look like? It's just a guess. It's my guess. I know that the one guarantee is that the interest on the bonds, on the new bonds, will go up. Okay, and that would also have another meaning on the existing bonds, because if you bought a bond that expires in 10 years or in 15 years, you are locked in a certain rate of return. Okay, and so the bonds not only have a rate of return, because you bought it at a certain period in time, so you bought it, for 10 years at 3%, 4%, whatever the rate was, but those bonds have also got a price. So if the rate moves away from your bond, so if you bought a bond that gives you 3%, and all of a sudden I can buy one on the market with the same expiry date that gives me 5%, why would I buy your bond? So what happens is that the bonds that you are holding, and remember that, people that hold bonds are, just think about it, apart from private individuals, but we're talking about pension funds, we're talking about other countries that have US dollars in their reserves. Obviously, they don't keep them in cash, they keep them in things that will give them a return. So this is going to affect not just the US, but the rest of the world, and make a lot of people a lot poorer by the increase of the level of increase that there is going to be on the bond market. So if the new bonds are priced at 2% more than they are now, that means there's going to be a drop, quite significant drop in the price of the existing bonds. Okay, and so yes, you can keep those bonds until maturity and get what it says on the tin, or you can sell them early, but you would have to sell them at a discount. Okay, so this is the meaning straight away, and it would affect pretty much everybody's pensions. If you have a pension that you don't manage yourself, but is managed by somebody else, that means that your pension pot will go down quite significantly. Okay, that's one first result. What the effect, then the domino effect would be like, it depends. But we could see then a domino effect. Definitely, there's going to be a lot of companies that, seeing this coming, will reduce the workforce and be working on a skeleton stuff, kind of like limiting the pain, because that will mean they borrowing costs going up as well. So the financing for the business operation will go up. So they will try to reduce, as much as they can, unless they are really, in an activity that's producing a lot higher than that. They will try to reduce their exposure to the debt markets, because they're becoming all of a sudden a lot more expensive. Okay, so that probably, if they reduce the number of employees, then everything kind of like they run their business on a reduced staffing levels for a little time. That will probably have an effect on their results as well, because they have less business and so on. So it could see a significant drop in the stock market as well. Okay, but that is kind of, we can start guessing, but they are kind of like wild guesses at the moment, and it's not the most likely option. Okay, the most likely option is that the debt ceiling will be increased and some sort of bodged up deal will be agreed between the Republican and the Democrats, because neither of them want to see the US to get into a really hard recession. Okay, now let's have a look at, over time, the difference that we have now compared to what we had a couple of years ago. Now, this is the differences, the yield on the government bonds. Okay, so the kind of like, if we look at the government bonds, are seen as the safest way of kind of employing your capital. Okay, and this is kind of like, if you see the zero line, so the real yield curve is the difference between the 10-year nominal yield on government securities and the inflation, not the inflation as it is today, but the inflation expectations at 10 years. Okay, so as you can see, in 2 years ago, and all the way through the economy boom that we've had, since 2000, recently, we had a real yield that was negative, in the sense that the reward that you will get for for buying and holding government bonds were less than the inflation expectations. So really, you were losing money just by buying US government bonds. Well, look at the difference between 2 years ago. So this was in 2021, basically. Okay, and then we'll have a look at what, if you remember, if you have a little bit of a long memory, remember what happened in 2021. And this is what we have now. Now we have a positive real yield curve. So it means that the money that you get by investing in security is more than the inflation. Okay, so in a way, when you are down here, what does a negative real yield curve encourages you to do? Anybody would like to guess?
Yes, sell your bonds.
Sorry?
It encourages you to sell your bonds and buy some
Just
new
sell your
ones.
bond. Yeah, but it's not just that, but just thinking about it from the point of view of a borrower, okay, it means that you can borrow money really cheap and employ it at a positive differential. Okay, so if you can, let's say, borrow money at 2% and you got a way of getting 3% from your investments, that means that you have a positive 1% on money that is not yours. Okay, and from the point of view of investor as well, from the point of view of investor, there isn't a lot of incentive to just buy and hold this bond, but there is more of an incentive to look elsewhere and look at kind of like because the bonds are not giving you enough, and say, let's see, what kind of investments can give you more than the safe options. And this is why kind of like, in a way, when there are positive real yields, it's seen as the conservative behavior is encouraged in a way, because why would you take extra risk in whatever risky endeavor you can think of, when you know that you can just be lazy, just put the money in bonds, and you know that in 2, 3, 4, 5, 10 years time you'll have more than you have today. Okay, where in if you put the same money in some of the risky investments, maybe stocks and shares, maybe a business venture, maybe crypto, you might have less. Okay, where when we are in negative yields, there isn't an incentive really for long-term savings. There is kind of, it's an incentive for you to go outside and try to find other ways of employing your capital so they produces a return, because the interest on the having just money in bonds, it means that in the long term your capital will have lost value over an extended period of time. So if you see on this other graph here, there is a real yields are actually an important driver of stock market valuations. Okay, you can see here the this is we looked at the 5-year real rates in this left hand chart, the blue line, and you can see that when the kind of like every time that the real rates are actually positive above zero, then the real the S&P 500 valuations start going down, and these are kind of like, this is an inverse of the price earning ratios. Okay, and so it's really important to understand that, you know, for companies, is when the real yields are negative, it's kind of like it's happy days for borrowers in a way, and not happy days for investors. Okay, so what happened in 2022 is the Fed really changed its stance. And you know, as Jerome Powell, you know, like is coming out today with a speech, started making noises that they wanted to see real rates going back above zero in the positive territory. Okay, so that kind of like the sharp increase in real yields. Can you see this is in the green area, where the sharp increase of real yields happened? We had a kind of like the valuation of stocks went down, because when money is cheap, people are happy to pay a lot in terms of, you know, kind of like price earning ratios to buy stocks, because they think that they can get, you know, they can get returns which are better than what they're paying for the finance. Okay, once this changes, the whole equation changes, and so you know, people are not happy to pay these kind of like high prices anymore for stocks, and they want more value for buying, you know, for buying stocks. So I'll now kind of like what does that mean for the real economy? Now we're talking about stock prices here, but from the point of view of the real economy, how do real yields come into it? There is such a concept called real yield equilibrium, which is kind of like a rate of real yield that allows both you know, the economy to grow in a kind of like steady at a steady growth rate, without overheating the economy and causing excess inflation. Now, what is this rate of return that that produces the equilibrium is estimated at being between 0 and minus -0.25% for the US, and for Europe it's estimated to be a minus 0.5 to 0.75%. Okay, real yield we're talking about here. So not the interest rates, but the difference between interest rates and inflation expectation, that is. So if you kind of think about it, the more productive, and we've been talking in the past few weeks as well about demographics and about productivity. So the younger a certain country's population is, and the more productive it is, the higher the real yield equilibrium rates are going to be, because the economy is growing really strongly, so it can afford a higher rate, a higher real yield, and to work in equilibrium. The problem is that both the demographics and the productivity has gone down. So now, as I say, for countries to be in equilibrium, they require, you know, very low rates of real yields. And every time I go on to the last of the, don't want to annoy you too much with too many charts, but this, you know, to show you the differences, that every time we have been above zero. Okay, and these are 3 cases are highlighted. You know, we had the recession in 2001, we had the great financial crisis in 2000, you know, the period 2008, we had the market crash, and then we had a stock market crash in 2018. Okay, so where are we right now on this graph? So we're seeing at kind of like the highest we've reached, whether in a financial crisis, was about kind of like 1% of real positive real yields. And all the time that we've had growth, as you can see, we've had negative yields of, you know, a lot of the time they were between -1% and 2%, you know, with then some periods of less, some periods of more, but generally speaking, the periods of growth are all being periods of negative real yields. Okay, now let me go out of this. So what do you think we are now in terms of, you know, holding kind of like inflation beating securities, bonds, at least in the US we're talking about? Okay, any guess?
We're on our way up, maybe.
We're definitely up. We're definitely positive. And this is, and you can check it yourself, by the way, go on Yahoo or anything. These are the tips which are Treasury inflation protected securities. Okay, so these pay you 1.4%. Okay, 1.4% on your money, plus they will give you an inflation adjusted capital at the end. Okay, so basically is 1.4% above inflation, whatever inflation is. Okay, now whenever the this number has been at, as you can see before, as I showed you before, anywhere near 1%, something broke in the economy. Okay, and then it had to actually dive down to go below 0 again. Now we are levels that are now kind of really unprecedented. Kind of this is a big, it's a lot of money to pay on top of inflation. So we'll just put that on top of, you know, for example, what's inflation at the moment? About 5% in the US. So we're talking about 6.5–7% interest rate, interest that you will get in on your these inflation protected securities. Okay, so what it is that is going to break, and you know, and what would it mean? Because it's really it's really quite striking, you know. And as we were saying, the US is paying more and more of its income on just servicing the debt. Okay, so it's funny enough that we've had plenty of these debt ceiling discussion. We probably will end up with a new deal and a new, you know, more money being spent by the government. But all that has resulted until now is basically move the problem, just keep the problem down the road, because you know, the problem has gone from personal debt to then move on to company debt, and now we're going to sovereign debt. And you know, what I was showing you last week is that the government, as a percentage of the whole economy, has become bigger and bigger and bigger. And when you think about it, you know, which are the productive sectors of the economy? The ones that actually produce the wealth that we all live by. And if you think about it, the government is not one of them. Or the government is there to regulate, to make things happen in an orderly fashion. But if they take a bigger part of the economy, that means that they put a lot of strain on the section of the economy that needs to feed the government itself, because what the government spends and needs to get in somehow first, whether it's from taxes or whether it's from you know, from issuing debt. So there isn't any way out. So the other kind of like the difficult decision is that from politically, nobody wants to say, actually, we are spending too much as a country. It's like we're living beyond our means, because that's a political suicide. You know, this is why they, you know, people like you know, Donald Trump come into power, because they're happy to tell people like a fable, you know, and people are more willing to listen to that than to listen to a reality and thinking, well, actually, people that are already struggling, because we'll say we are close to 50% of the American households that are living really on the breadline. So if you tell those people, and you're talking about a good about 50% of the electorate, you actually you have to tighten your belts, you're not going to have a good reaction. Okay, so obviously politicians first and foremost are looking after themselves, so they want to be re-elected. So nobody will take the hard decisions that need to be taken. So if the politicians are not making the right decision, who will? And the markets are not, they don't care, really. So sooner or later, something will break and the markets will make that decision for the politicians. So it will reprice the assets as something that is, enables them to carry on, and the market doesn't. So what happens when the market drops 60, 70%? Well, they just carry on. Yeah, they drop 60% and tomorrow is another day. But what happens to the people who hold those securities? What happens to this life? Those are the casualties of the of this repricing of the world that we live in. And there is no free meal here. So we've all enjoyed worldwide in a period of real we can say increase in the standard of livings, but not because it's a sustainable increase, but simply because we've been letting somebody else pay for it. Kind of like when the proverb hits the fan, we won't be there to pick up the pieces, because the baby boomers that were born in the just at the end of the Second World War will not be there to financially contribute to rebuilding. Okay, because by now they're the ones that are drawing the pension and the ones that are on the part of society that needs to be supported by the workers. Okay, so I know it's not pleasant to hear it, but that's a reality. So we can only look at the data and then we'll see how the politicians will deal with this data. The one thing I can tell you, kind of like from a personal point of view, this is really not the time to be making kind of like long-term decisions on your investments, in the sense like committing your funds for a long period of time. I am kind of like trying to keep pretty nimble, making kind of like short-term investments until this plays out, because it will play out and it won't be long either. Now let's have a look at some of the other. Let's move on from this. Let's have a look at some of the other things. So we see, who do you trust right now? Okay, so this is one of the largest bank in the US. Okay, called Wells Fargo. They just agreed to pay $1 billion to settle a class action lawsuit connected to illegal practices that they perpetrated against the American public. Now, obviously, they agreed to pay this $1 billion, but they don't take any blame. They say, well, we agreed. We don't agree that we did anything wrong. Okay, but we'll pay you $1 billion to shut you up. Now, so while we disagree with the allegations in this case, we are pleased to have resolved this matter. Now, what they did for that is the illegal conduct led to billions of dollars in financial harm to its customers, and for thousands of customers, the loss of their vehicles and home. So consumers were illegally assessed fees and interest charges on auto and mortgage loans, had their cars wrongly repossessed, and had payments to auto and mortgage loans misapplied by the bank. Okay, Wells Fargo also charged consumers unlawful surprise overdraft fees and applied other incorrect charges to checking and savings accounts. Now, obviously, this is kind of quite bad, because it's kind of, they're supposed to be a reliable place where you store your wealth, but this is not isolated. So when you're thinking about, how can I keep my money safe, and just think about it twice when you think that the banking sector is one of these places, because these things happen again, and if you are just a lonely consumer against a big power that, like the banks, taking them on is not easy. It's not easy, and they got much deeper pockets than you have, and they can afford. By the way, $1 billion will not even tickle them. Okay, and even if it's a lot of money, for them it's a lot less than what they made by applying those practices. And this is how lots of businesses operate. They don't operate for the best possible result for their customers. They operate for the way that makes the most money. This is, we have in the UK, I don't know if you follow that, probably not if you're not in the UK, but in the UK, for example, there is a big scandals with water companies, okay, which are discharging the sewage in rivers, okay, without any filter. Okay, that is killing a lot of the, you know, a lot of the ecosystems in these rivers, and it's kind of like, in a way, becoming, some of them are becoming almost like open sewers. And the thing that the scandal that came through was not that this has happened, because it's always been kind of like an emergency release when the, you know, when the sewers are over capacity. But the result, the scandal has been because, you know, many of these companies, it's become apparent that that was an economic decision, in the sense that they're happier paying the fines than putting in place the equipment they need to clean up, you know, the sewers and their emissions. So, you know, they did really well over the period, while at the same time they were killing their customers. And even now, after all these scandals, they are planning to put like a 10 billion project to clean up and their operation. They put new equipment in place, but they are planning to charge these 10 billion to their customers. So not only is they to add insult to injury, not only have they ruined everything, but they want to charge all their customers for the cleanup operations as well, which is what banks do all the time. So yes, we give you $1 billion, but in the meantime, we made about 10 billions from the same thing, and we carry on doing it, because the next time somebody comes knocking, we'll give them another billion and carry on just exactly what we just done. Okay, talking about now the difference between kind of like the reason why crypto is becoming popular. Okay, so this is Turkey, and Turkey and Argentina are close by from that point of view. You might have read in the news that the Argentinian government have raised interest rates to 97%. Yeah, that is 97% a year. Okay, and so that makes you realize that, what does that mean if you live in Argentina and you're doing really well and you have savings? That means that every year your savings halve in value, unless you do something, you know, for it to double in value. But if you just keep them under the mattress, every year your money loses half of what it's worth. Okay, so, and this is what I've been telling you many times, that the biggest change in this, in the crypto world, will not come from the biggest players, the US, the UK, and, you know, the Japan and so on, but will come from the countries that need this technology. Because if you have something, money left over at the end of the month, and you want to maintain its buying power, keeping it in the local currency, whether it is the Turkish lira or the Argentinian peso or whatever it is not the best option for the people that are living in those countries. Okay, so we're seeing as two of the biggest, you know, what are the three largest countries there in terms of percentage of crypto ownership are Argentina, Turkey, and the Philippines. Okay, and I told you before, in the Philippines, you know, there are now many places that accept the what's it called, the Sweet Love Potion, which is one of the tokens in the most popular crypto game, as payment for in shops, because nobody wants to keep to take the local currency that the value basically is burning a hole in your pockets every time you hold it. Now, just a couple of things, and then we'll take some questions. Okay, this is the Chamber of Digital Commerce that has urged Congress to set up a digital asset and blockchain technology commission, okay, to develop crypto regulation. Because what they're saying, and which is what we've been discussing on an informal way for many months, is that they are, by their activity, the US authorities are pushing the technology towards other nations. And this is the most interesting technology right now, and apart from maybe artificial intelligence. And this is being pushed outside of the US because of the kind of a contrarian attitude towards the institution. They are trying to do everything in their power to ban crypto projects in the US by making it so difficult to operate that they've got no option but to move away. Okay, so it's interesting now that these things are starting to be pushed, and just even they are publishing the difference between the US and China. Kind of like is developing the international focused blockchain-based services network. Okay, which is also part of the plot in a way to move away from the dollar for international trades. So even now, there's a growing number of countries that's considering or choosing to trade with China directly in yuan, okay, and ditching the dollar. So like Saudi Arabia, Russia, France, Brazil, and India. Okay, so it's actually becoming quite stark, and this is this is the one thing that could, if the American technology was dominating the blockchain space, and especially with stable coins, that would just give another reason to hold on to American dollars, because from a practical point of view, it will take a lot to replace the dollar with anything else, whatever that anything else is. But in all of this that is going on, definitely crypto is starting to become more acceptable in the sense as a hedging strategy, as a I'm not saying as a outright investment, but if anything else goes wrong and everything starts crashing, obviously crypto might be one of those that crash as well. I'm not saying it doesn't, but it offers a different alternative to asset classes that can grow exponentially simply by somebody deciding to produce more. And crypto, like especially talking about Bitcoin and the cryptocurrencies, they have a fixed ceiling. They have got a maximum issuance. So once those coins are issued, they're issued, and you can't possibly produce anymore. So it's easier to understand how the value will hold over a long time compared to something else that gets, whose number gets increasingly higher and higher. So the last couple of things. One of these, you might have been aware of Ledger. Ledger is the most famous and most used crypto hard wallet. Okay, I've got one here in front of me. So this is a Ledger device. Okay, and there was a controversy because of a tweet that they put out, which is this one. Technically speaking, it is and always has been possible to write firmware that facilitates key extraction. These are talking about private keys. So you can't access a Ledger device without a private key. But you always trust the Ledger not to deploy such firmware, whether you knew it or not. Okay, so this is somebody that wrote that, and there was been a huge outcries in the crypto world, thinking, well, this is supposed to be the ultimate safety in the sense that if you know the code to access this, you can't get the seed phrase, so you can't access that wallet. Then you're thinking, well, if Ledger has got the potential to access that seed phrase, would a hacker have the same potential? And how long would it be before somebody was hacking a Ledger device that's not connected to the internet, and whose owner has never shared the seed phrase with anybody? Okay, so they have been kind of backtracking. They've deleted this tweet, and they kind of said that it's not possible for them to it was not possible for them to extract customers' private keys, etc., etc. Okay, but definitely that has because they launched this new Ledger recovery service that allows user to back up the secret recovery phrase, basically the seed phrase. Okay, it's by splitting into 3 shards and sending it to different data custody services. But this is, so really speaking, a lot of people have been very uncomfortable about this, because this will be introduced with a new update of the software. And although you can, not update your software, if at some stage you'll need to update your software, otherwise your device will not work properly. So the fact that this is a possibility is worked into the system would open a vulnerability in the devices. Now, it's so it is kind of a concern that shakes one of the strong say options, things that we all banked on, saying once you have a hard wallet and you're careful the way you use it, nobody can get to your funds. Well, now that safety has been shaken a little by having this kind of like, in a way, a backdoor to your funds, and it's not a positive at the moment. It looks almost like a real on goal by Ledger. Kind of, this is something that maybe a third party could have offered, and if you're happy to maybe by having 2 or 3 separate third parties, you could have done that. But the company, so the same company that operates the device, has access to your private keys. That creates a massive uncertainty in the security of the device itself. So we'll see how it develops in the next few weeks. But at the moment, if I can say something, until this is resolved, don't update your Ledger software for at least a week or 2, and then we'll see what they come up with. The last thing, we talk about crypto a lot, and some of the projects about Cardano. Okay, now why did I bring this to your attention from the University of Edinburgh? Because Phil Wadler, which is a professor of theoretical computer science at the School of Informatics there, has been elected a fellow of the Royal Society. Now, apart from anything, if you know some of the names that there were previous fellows, they have some people like Isaac Newton, Charles Darwin, Albert Einstein, etc., including one of the last ones, Stephen Hawking. So it's a pretty important accolade that only a few people receive. Are granted to individuals who have made a substantial contribution to the improvement of natural knowledge. Okay. So say each year up to 52 new fellows from the United Kingdom, the rest of the Commonwealth of Nation and Ireland are elected. Now, the reason why I bring it to your attention is because is a very, very important in computer science. He's one of the founders of several computer languages. In particular, is the one that created Haskell, and is also worked in conjunction to Cardano to create Plutus, which is the new smart contract language. Now, one other thing that they're working together, they've received some funds from Cardano as well to develop a that's what's it called, decentralization quotient, so a way of judging how much the different blockchains are decentralized, and come up with a number that represents the level of decentralization. Now, this is, by the way, just to show you how Cardano works. Okay, this is Cardano. I mean, this is, I'm not sure actually if it's the Cardano Foundation or the IOG that funded this research, but they have got no control about what they actually do and how they use these funds. These funds will not just be for Cardano or for the company behind Cardano to use, but they open source for everybody to use. So they can neither influence the research nor get a benefit from the research ahead of anybody else. And this is about all the many different research papers that have been published by Cardano. They form the base of the Cardano blockchain and the technology behind it. All of these research papers are open and available to everybody to use. Okay, now this is, again, when I tell you to look into a blockchain and how they work, these are the kind of news that you should pay your attention to. So these are the kind of caliber of people that Cardano is working with. Okay, and so just a brief things to because sometimes we talk about high level about these things, but it's difficult to put them into practice and make it understandable on a normal level. Just go and look at the other blockchains and see who they're working with, and then that will tell you, kind of how serious they are about what they are doing. Okay, now I think I almost managed to finish the hour on my own. Let's take some questions. Now, who did the US owe the most to? Their citizens. A big part is owned by the citizens, but also a big chunk of US bonds is owned by foreign countries. So any central bank will have US dollar reserves, and those reserves are not in. They don't have a pile of cash sitting on the sitting in the central bank. They will have bonds, in as their reserves. So. And also, if you have a pension, the pension funds will own part of those bonds as well. Obviously, depending on where the pension fund is, generally they will have a big part of the investment in that country's, of that country's investment vehicles, but part of it will be invested as well in dollar bonds. So. I would think I'm not quite sure about what the rate is, but I would think it's about 60-40, probably 60% kind of like in the US and 40% outside. Don't quote me on that, though. That's just a kind of like an educated guess. Somebody would like to ask a question? Feel free to unmute yourself.
Hey, Luca. Good morning. It's Chad.
Good morning, Chad.
Luca, in terms of protecting your family and getting a return, etc., and maybe I'm putting you on the spot, what's your focus in what's probably a confusing time, right, for investors? Where are you going for safety and diversity, etc.?
Yeah. Most of us, so I will think this is a time really to spread the risk, I will say, because it's very difficult to understand exactly what asset classes will, be successful in the long term. But what we can say, just looking at the data, see what's happening at the moment. For example, I don't know if you've followed the US dollar recently as grown up in value, and sometimes the markets don't really make sense, okay? Because you're thinking there is a debt ceiling problem. The US might be defaulting on its debts. And so what happens is that the market goes to safety, goes for safety. And what's the main safety is the US dollar. But the US dollar is involved in the US debt ceiling debacle. So, but it's sometimes it doesn't really make sense. But recently speaking, we've seen, gold and precious metals go up in prices. So definitely, if you have an extensive portfolio, you should have part of it invested in precious metals. We've seen obviously the biggest winner in 2023 has been crypto. So definitely a part of it should be invested at least in the top, I would say, without going far, just in the top tokens in crypto. And the investment for me in kind of like stocks and other type of investment, I'll keep them all on kind of a short-term basis. Kind of like don't really want to. I mean, what you offer, for example, with the structured notes, that's interesting because it allows you to get some short-term return, but also have a security long-term, and that's a really a good balance to have. But generally speaking, I mean, would I put most of my money in the stock market right now? I wouldn't. And would I put it all in any particular asset class? I wouldn't. It's just like, if I can say, really cover all the bases and be nimble and be also, in a way, cash rich. Because if we hit a really good patch and something breaks, the things that you'll be able to buy at the bottom of the market will be kind of a generational buy, like it happened already in 2020. Now, obviously, that was difficult to predict, but if anybody bought in March, April 2020, it doesn't matter what you bought, you would have made many times your investment. And if that happens again, that would be the other thing. But the thing to ask is, would you have anything to buy with if that was to happen? So definitely this is a time also to be kind of like cash rich rather than 100% invested. But a nice balance. I would say maybe, at the moment we probably sit in about 50% in cash, personal level, and 50% invested in several things.
Thanks for sharing.
No problem. Anybody else? No? Okay.
Sorry, Luca, could I just ask, I think
Sure.
To get a recording of this, I got a recording a few weeks ago of that time, but it just takes you to that actual recording. Is there a sort of site where they're all kept, or? It's
on my personal YouTube channel. So if you go, let me see. I'm gonna get it to you. You know what? I'm not great with things, but say my channel should be this one. Okay. So this is the. Oops.
This is just great economics, and my son's doing economics, and I think it would be a great benefit to him.
Oh, thank you. So that's my YouTube channel. I go into. It's not on the videos section. It's on the live section.
Brilliant.
So
Thank you.
they're all listed on there. Okay. Ellen is asking a question. If you want to invest in the blockchain technology because we see its potential, would that mean investing in the coin? It not necessarily, but the coin, which coin do you talk about? The coins of different blockchains, or because there are many projects that are blockchain, they use blockchain technology, but they don't produce their own coin. Blockchain in general, it's a technology that would be used by most businesses the same way as today they use cloud computing. So so you can invest in the coin or can invest on the companies that produce the hardware, for example, that blockchain runs on. So there are many different ways. In terms of the coin also, as you know, in crypto, there are thousands and thousands of coins. They're not just the one. When investing in the coin is which coin, that's the question. Okay. But yes, you can either invest in the coin or in companies that are connected. For example, one company that doesn't have its own coin, like Messari, for example. Messari does research. Thank you, Jonathan. Messari does research on crypto projects. Okay, they don't sell anything themselves, but they are they are a company that produces research on crypto. So as you can see, there are different ways of investing in blockchain technology as such. And there are, for example, who produces the mining chips for Bitcoin mining. So if you see the producers of those chips, for example, are a way of investing in blockchain technology without directly having to buy cryptocurrency. Okay, and so on. There are other producers, for example, that produce the containers that are used to host the mining chips and so on. But there are many things that are connected with blockchain. They are not directly crypto. Okay, so crypto is obviously the most obvious one, but not all of them are crypto related. Okay, so we've now gone over 9 o'clock. It's 9:05. So I remind everyone, most of you are kind of like I've been here before a few times, so you all know Jonathan is running a Cardano room at 9:30. So the link is on the chat. So if you don't have the link already, please click on it now before I close this. And if you do have the link, then there's nothing to stop you from joining this session. So, if there are less than this number of people right now on this session, then I'll ask Jonathan to report, and I can tell you off next week. Okay.
I think there's a question from Helen.
I've already answered Helen's question, I think. Yeah, I already answered any questions. I know that you're driving, so you can't talk, but if I can't hear any follow-up questions, I can't answer it. Okay, so we'll see you again next week. Helen, if you want to discuss anything in particular, just book a session with me and we'll have a chat. Okay, all right.
Thanks, Luca.
I wish you a great weekend, and I'll speak to you all soon.
Thank you very much.
Thanks.
Bye, everyone.
Ciao.